This is Macro Intelligence Report with Ethan Clark. Today we're decoding the latest macro data and market signals. Let's begin. It finally happened. And almost nobody is talking about what it really means. Because buried inside one cold, boring-looking data point is a signal so loud, so historic, and so dangerous for the average person in the United States that once you see it, you can't unsee it. Gold just took over the US dollar. For the first time in 30 years, central banks now hold more gold than US debt. Let that land for a second. Central banks, meaning the institutions that sit at the top of the global financial pyramid, the ones who see the money flows before they hit the headlines, are voting with their balance sheets. They're telling you what they believe is safe, what they believe is real, and what they believe is coming next. And what they're telling you is terrifying if you live in the USA, because it means the world is losing trust in the US dollar at the sovereign level. Not on Twitter, not in conspiracy forums, not in some doom blog, at the central bank level. This is not a fear trade anymore. This is a strategic reallocation away from paper promises and toward a neutral asset that has survived every regime, every war, every collapse, every currency experiment for thousands of years. And it's happening because foreign countries don't care about earning interest anymore. They're terrified of losing their principal. That's the part most people miss. The mainstream narrative tells you treasuries are attractive because yields are higher. So people assume the rest of the world is thrilled to lend to the US. But that's not how real capital thinks when the stakes are national survival. When you're a foreign nation holding reserves, you're not trying to squeeze yield like a retail investor chasing a dividend. You're trying to preserve sovereignty. You're trying to preserve purchasing power. You're trying to preserve the ability to import energy, food, medicine, and critical supplies under stress. And if you believe there's even a chance that the asset you're holding can be seized, inflated away, or politically weaponized, then yield becomes irrelevant. Because 4% interest means nothing if you lose 40% of your purchasing power, or you lose access to the asset entirely. US Treasuries can be seized. That's not a theory. That's a fact of modern financial power. If you're on the wrong side of geopolitics, your risk-free asset can suddenly become a frozen asset, a blocked asset, a hostage asset. And even if it isn't seized directly, treasuries can be inflated away because a bond is a promise to pay you back in dollars, and the value of that promise depends on the value of the dollar. So if the dollar is being debased, meaning more units are created while the real economy can't keep up, then the bondholder is repaid, but repaid in weaker money. And when nations start to believe that debasement is not a possibility, but an inevitability, they begin doing the only rational thing: they exit. Now compare that to gold. Gold has zero counterparty risk. It doesn't rely on a government's ability to tax. It doesn't rely on a central bank's credibility. It doesn't rely on a payment system staying friendly. It doesn't rely on a promise. It simply exists. It is the only true neutral asset. And the world is waking up to that neutrality at the worst possible time for the United States. Because the debt math is breaking. And it gets worse. US debt is rising by $1 trillion every 100 days. Read that again. $1 trillion every 100 days. That's not a slow creep. That's not, we'll grow out of it. That's a compounding machine. And interest payments are passing $1 trillion per year. That means just the cost of servicing past debt is now consuming an amount of money that would have been unthinkable not long ago. This is the trap. When interest payments become that large, the system becomes addicted to lower rates. Because higher rates mean higher interest expense, which means more borrowing to pay the interest, which means even more debt, which means even more interest. It feeds itself. And when the system reaches that point, the Federal Reserve has to print. Not because they want to, because the alternative is the kind of disorder that breaks governments. The Fed has to print, and the world sees the debasement coming. So they're getting out now, not later, after the headlines, not after the crisis hits, now. And you can see it in the reserves. This is the key point. The shift is visible. China, Russia, India, Poland, Singapore. Everyone is dumping paper for hard assets. They're not doing it in a single dramatic moment. They're doing it in the way professionals do it, quietly, steadily, strategically, while the public is distracted by whatever story is trending this week. They are swapping exposure to paper promises for exposure to something that cannot be printed out of thin air. And this isn't just gold bugs being gold bugs. It's national strategy, because once you accept that financial assets can be weaponized, you start building a system where you cannot be weaponized. And that brings us to the BRICS alliance. Most people hear BRICS and they think it's just headlines, a talking point, a political club, a loose coalition. But don't forget what this is really about. This isn't just about trade deals. The goal is de-dollarization. And de-dollarization doesn't mean the dollar disappears overnight. That's not how this works. It means the dollar loses its monopoly position in global settlement. It means the world slowly builds alternatives, independent payment rails to bypass SWIFT, settlement systems that don't require U.S. permission, and trade frameworks that reduce the need to hold U.S. assets as collateral. It means settling energy in local currencies. It means moving away from a single dominant settlement currency toward regional blocks and commodity-linked settlement where possible. And it means backing it, at least psychologically, and possibly structurally, with commodities that can't be printed out of thin air, like gold and silver. This is the part that should make your stomach drop if you understand how the dollar system works. Because the dollar's strength is not just America is big. The dollar's strength is demand. Global demand for dollars. Demand created by trade settlement. Demand created by energy markets. Demand created by the need to hold reserves. Demand created by the need to buy treasuries as the default safe asset. So when a massive portion of the world starts deciding it doesn't need the dollar the way it used to, demand is gone. And when demand is gone, the game changes. If 40% or more of the global population decides they don't need the dollar, at least not for the same percentage of trade, not for the same percentage of reserves, then the structural bid under the dollar weakens. And in markets, when the structural bid weakens, the price has to adjust. Now here's where most people get confused. They assume the dollar is just the cash in their wallet. But the dollar system is much bigger than that. It's the entire architecture of global finance. What people settle in, what they store value in, what they lend in, what they borrow in, what they insure in. So when central banks pivot away from treasuries and toward gold, they are not just making an investment choice. They're making a statement about which system they trust. And the statement is, paper promises are no longer the unquestioned foundation. Now there was a phrase that defined the last era of markets, TINA, there is no alternative. No, rates were low, liquidity was high, and people were pushed into risk assets because cash was trash and bonds didn't yield enough. But that era is over, because now the alternative is staring everyone in the face. Gold is the alternative. Not as some exotic speculation, but as a reserve asset, a neutral asset, an asset that doesn't depend on somebody else's promise to pay. And once that mental shift happens at the sovereign level, the repricing can be violent. So, is this the fall of the US dollar? Yes. Absolutely. Not in the dramatic Hollywood sense where everything collapses overnight and people start trading canned food tomorrow morning, but in the structural sense, the sense that matters for your purchasing power, your cost of living, your ability to build wealth, and your future standard of living. Because when the reserve currency begins losing trust, the country issuing that currency faces consequences that most citizens don't understand until it's too late. It means imports cost more. It means commodities trend higher in dollar terms. It means financial repression becomes more likely. It means policy choices become narrower and more desperate. It means the hidden tax of inflation becomes a permanent feature, not a temporary bug. It means the government has a stronger incentive to inflate liabilities away, because that becomes the politically easiest path. And if you think the numbers that get thrown around in precious metals are crazy, if you think silver at $90 and gold at $4,600 is insane, then you aren't prepared for what's coming. Because those numbers only feel insane if you assume the current system stays stable. They only feel insane if you assume the dollar's credibility remains intact. They only feel insane if you assume global demand remains constant. But the point is, demand is shifting. Reserves are shifting. The psychology is shifting. And that's what drives long-cycle moves. Not headlines, not opinions, not narratives. Balance sheet decisions by nations. And when nations decide the principle matters more than the interest, when they decide counterparty risk is unacceptable, when they decide neutrality matters more than yield, they go to gold. Now, I want to slow down and say this as clearly as possible, in simple language. This is not about hating America. This is not about cheering for collapse. This is about incentives and survival. If you are a foreign country watching U.S. debt rise by $1 trillion every 100 days and watching interest costs move past $1 trillion a year, you are watching a machine that eventually has to be fed. And that feeding comes from one place: currency creation. Whether it's direct money printing, indirect monetization, or policy that forces savers to accept negative real returns, the end result is the same. Your dollar exposure is a bet that the U.S. can hold the line, a bet that the U.S. can maintain discipline, a bet that the U.S. can avoid debasement. And the world is deciding that bet is no longer asymmetric in their favor. So they're moving into assets that don't require belief. Gold doesn't require belief. Gold doesn't require permission. Gold doesn't require a functioning SWIFT relationship. Gold doesn't require that your reserves be approved. That's why it's the only true neutral asset. And that neutrality becomes priceless when financial systems become tools of geopolitical pressure. Now, layer crypto on top of this, carefully, because we're not expanding the story beyond your key points, we're reinforcing them. Crypto has taught an entire generation one core lesson: scarcity matters. When people watch assets that can be created endlessly, currencies, credit, debt, lose value over time, they start searching for things with hard constraints. Crypto is a digital expression of that instinct. Gold is the ancient expression of that instinct. Different forms, same psychological root. So when you see central banks choosing gold over treasuries, you are watching the ultimate institutional version of scarcity matters. And you're watching it happen because they don't trust the principle. And here's the uncomfortable truth for the average American. When foreign demand for treasuries weakens, the U.S. still has to fund itself. The deficits don't disappear, the interest doesn't disappear, the obligations don't vanish because the buyer base got nervous. So if the world buys less, then either domestic buyers must buy more at higher yields, or the Federal Reserve fills the gap. And that's why the Fed has to print. Again, not because of ideology, because of math. The world sees it. That's why they're getting out now. That's why the shift is happening in reserves. And it's why this story is so urgent, because most people will not act until the pain is obvious. They'll wait for the official confirmation. They'll wait until the mainstream says it's safe to worry. They'll wait until the price has already moved. But the institutions don't wait. Central banks don't wait. They move early, quietly, based on signals most people never track. And the signal here is massive. More gold than U.S. debt in central bank reserves. For the first time in 30 years. That's not a footnote. That's a regime change. And if you're sitting in the United States thinking, okay, but how does this hit me? It hits you through purchasing power. It hits you through the cost of real things. It hits you through the fact that your savings are denominated in a currency whose external demand is being questioned. And that doesn't mean you should panic. It means you should understand the game you're in, because the game is changing. The era of Tina is over. Gold is the alternative. Now, I'm going to say something that might sound extreme, but it's the logical endpoint of everything we just laid out. When trust erodes, the repricing is not linear. It's not a gentle slope. It can be sudden. Because financial trust works like this. For a long time, nothing happens. Then everything happens. For years, the system appears stable, even as the fundamentals rot. And then one day, the market realizes the fundamentals were never repaired, only hidden. And then the move that could never happen happens in months. That's why people get caught, because they confuse stability with safety. And the entire point of gold's role in this story is that it is safety that doesn't need stability. Gold is what you own when you don't want to depend on someone else's balance sheet. And right now, nations are screaming that they don't want to depend on the U.S. balance sheet the way they used to. China, Russia, India, Poland, Singapore, dumping paper for hard assets. And BRICS pushing independent rails, bypassing SWIFT, settling energy in local currencies, building commodity-linked credibility. This is how reserve systems shift, not with a press conference, with infrastructure, with settlement, with reserves, with slow, relentless reallocation. And the scariest part? Most people won't realize what happened until after it's done. They'll wake up one day and wonder why everything costs so much more. They'll wonder why their money doesn't stretch. They'll wonder why saving didn't protect them. And they'll be told it was unpredictable. It wasn't unpredictable. The world is telling you, right now, in the reserves. Now, I'm going to bring this home with one more blunt reality. If you think the dollar is immune because it's the dollar, ask yourself why central banks are choosing gold over U.S. debt. Ask yourself why yield no longer matters to them. Ask yourself why principal protection is suddenly the priority. Ask yourself why neutrality is suddenly the priority. And then ask yourself what happens when that mindset spreads. Because when the biggest players stop playing the old game ends. And that's why I'm telling you, yes, this is the fall of the US dollar. Absolute. Not as a dramatic overnight extinction, but as a long cycle decline in dominance and trust. And in that kind of decline, hard assets don't just rise, they reprice violently. So silver at 90 and gold at 4,600, if you think that's crazy, you're thinking in the old framework. You're thinking in the TINA framework. You're thinking in a world where the dollar demand base is stable. But when 40% or more of the global population decides they don't need the dollar, demand is gone. And when demand is gone, you will see numbers that feel impossible until they're printed on your screen. Now I'll be completely direct. I've been in macro for over 20 years. I've bought and sold every market top and bottom for over 10 years. I've watched cycles form, break, reset, and form again. And I've watched the public get baited into the wrong trade at exactly the wrong time, again and again, because the public is taught to look at the wrong signals. They look at headlines. They look at opinions. They look at short-term noise. But the real signal is what the largest balance sheets are doing. And right now, those balance sheets are moving into gold. That is the signal. Starting now, I promise to share my moves publicly for you to see. Not in hindsight, not after the trade worked, not after the market already moved, publicly. Because if you want to hedge against 99% of retail investors, all you have to do is follow me. Most people will keep playing the old game until the old game breaks them. They will keep trusting paper because it's familiar. They will keep believing the system is stable because it's always been stable in their lifetime. They will keep waiting for permission to protect themselves, and then one day they'll realize the people at the top didn't wait. They moved, quietly, years in advance. And the moment you understand that central banks now hold more gold than US debt for the first time in 30 years, you realize this isn't a debate anymore. It's happening. And if you're paying attention, you can position yourself on the right side of it. Not out of fear, out of clarity. Because the world is re-rating risk. They're re-rating paper. They're re-rating counterparty exposure. They're re-rating the credibility of debt. And they're re-rating the dollar. And gold is the recipient of that re-rating. So here's the closing message I want to leave you with. Something you should remember the next time someone tells you this is just another gold story. This is not about gold. This is about trust. When trust dies, the price of everything changes. And the people who survive aren't the ones who were the smartest in hindsight. They're the ones who saw the shift early and acted while it still felt uncomfortable. Gold just took over the US dollar. Central banks just told you they care more about protecting principal than earning interest. They just told you they're terrified of debasement. They just told you they want neutral assets with zero counterparty risk. They just told you they see de-dollarization accelerating. And they just told you, in the only language that matters, allocation, that the old era is ending. Many people will regret not following me sooner. Powerful, clickable title. Gold. Just replace the dollar. Central banks are quietly preparing for what's next.